I've actually been in the finance industry now for 20 years. I started out at Lake Michigan Credit Union as a teller, and then I moved over as a receptionist at Oppenheimer and Company and became an assistant and then became their operations manager while I was going to school at night at Grand Valley. I did 2 years at community college, and then I did 4 years going to night school at Grand Valley, finishing up my bachelor's with a double major in finance business management. After Grand Valley, I went on to become a certified financial planner professional. Also became an accredited investment fiduciary, which is really just on the investment management process and how do we go about putting together an investment portfolio. And I'm also a certified plan fiduciary advisor, which is for retirement plan consulting I work. So I do work with employers helping them manage their 401ks and 403bs. So I was formerly on the Grand Valley State Alumni Board. That's where I made connections with Kyle back in the day, Chris Barbie and Susan. And I just really enjoy being able to provide this education to Grand Valley alumni. And in my free time, I'm on the finance committee for Safe Haven Ministries locally, as well as I have a 13 and 15-year-old. So I play a lot of the minivan mom role right now, getting them to and from their sporting events. So just wanted to give you a little bit of background about me before we dig into things today. So the first thing I want to talk about is how your investment strategy might change. I think the accumulation phase is the easy part. We are saving, hopefully your employer's matching or putting something in for you into your 401k or your 403b. And then a lot of times we can just press the easy button when it comes to investing, right? A lot of times there's a strategy you can pick that is aligned for when you plan on retiring, and they professionally manage it for you. So it's the easy button. But when you retire, when we're thinking about the decumulation phase and as we're taking money out of our investment strategy, we need to change things up a little bit. So then we're going to go in a little bit and talk about how much can I withdraw from my portfolio when I retire, right? We don't want to run out of money. So we're getting some Social Security income, hopefully. Very few of us have pension income, but maybe you're one of the lucky ones. And then how much can I take out of my investment strategy? And what does that look like, right? And then at the end of this, we're going to talk about tips and tricks. We're going to talk about required minimum distributions. We're going to talk about qualified charitable distributions. We're going to talk about why you might want to think about Roth conversions in retirement. And then a lot of this is talking about working with a financial advisor. And my goal is to just let you know some of the reasons as to why you might want to consider working with a financial advisor. There's a lot of us out there, so we're going to talk about things to consider if you're hiring one. What is their average fees? Because I believe the last time I pulled up the statistic, I think it's around 80% of people who retire choose to work with a financial advisor. And I would say that's because when you're in retirement, it's just a little bit more complicated than when you're in the savings phase. So we're going to talk about those things too. And then anything else that comes up along the way. So when we think about investment strategy, we need to think about what's the appropriate level of risk for you. We'll go over a little bit of the importance of an institutional investment process and diversification. I'm going to talk to you about the bucket strategy when it comes to investing. Staying the course, that applies to you whether you're in retirement or before retirement, but really staying the course when it comes to investing, right, during the market downturns. And then what you might want to consider when you're thinking about an individual retirement account or an IRA, okay? So the first step is just when you do retire is thinking about the level of risk that's appropriate for you and your situation. And this is going to be different for everybody. And a lot of it has to do with, some of it has to do with how much you have saved for retirement. And some of it has to do with your own comfort when it comes to investment risk. The same area in our brain lights up when we see our investment portfolio go down in value, right? So there's a market correction. My $100,000 I had saved just dropped down to $80,000. When I pull out that statement and I look at it and I see that, or I pull it up on an app on my phone, when I see that, the same area in our brain lights up as though we're experiencing physical pain. So we all have a different level of risk tolerance when it comes to investing. And usually when we hit our thumb with a hammer, we immediately want to pull away, right? And that's the same thing that happens when we're investing and we see that downturn in our statement. And so we're going to talk about that would be your comfort with risk, because one of the most important things you can do is stay invested during those market downturns. right? So we have to make sure you're in a strategy that you can bear and withstand that level of risk. When we talk about an investment strategy, a lot of times this is happening for you in your 401ks or your 403bs, automatically for you behind the scenes, right? So if you chose one of those, what we call kind of target date investment strategies when you're saving for retirement, and you kind of let TIAA or Fidelity or whoever it might be do it for you, they're looking at your age. They're thinking sometimes you get to choose the level of risk, sometimes you don't. But usually you'll be defaulted into like a moderate level of risk. And then they're saying, oh, well, Sue retires in, she's planning to retire around 2030. And so accordingly, we need to start scaling back the level of risk in her investment strategy. So that's happening. And then when you do retire, we have to figure out, okay, how do we want to move forward with your level of risk? So there's 4 parts when it comes to investment strategy, but the first part is just your risk assessment. So what's your risk tolerance personally? Also, how much money are you going to need and when are you going to need it? Because that is going to depend. If you need to take a lot of money out of your portfolio early in retirement, maybe before you're waiting for Social Security to kick in, then that's going to play into how much risk we want to take in your investment strategy too. I'm going to put a little plug in for Social Security. We have a Social Security specialist with us the end of February. I think it's February 26th. I'm taking a look here real quick. February 26th. Hillary Hatch, who is our local Kent County Public Affairs Specialist with Social Security, is going to be putting out a presentation for Grand Valley, and we'll dig into a lot more about Social Security strategies then. Any questions or comments right now, Kyle, that we should handle? Oh, you just put that, he put the link up in the chat. Love that. Thank you. So when it comes to investment strategy, a lot of this is happening for you behind the screens, but what an advisor is doing for you or when your portfolio is being professionally managed, we're looking at what do we think is going to happen in the market over the next 3, 5, and 10 years? What do we think is going to happen with international investments? What do we think is going to happen with US investments? Large companies, small companies, is there an AI bubble going on right now? We're looking at what do we think, these are called forward-looking market assumptions. What do we think is going to happen in the market over the next 3, 5, and 10 years, right? And then we look at your level of risk, which is step 2, and we create an asset allocation. Okay, so for somebody who maybe is moderately conservative, we would typically see maybe about 50% in equities and 50% in fixed income. But should we have 10% in international, or should we have 15% in international? Should we have 5% in real estate, or do we not like real estate right now and we don't want any exposure to real estate? So that's step 2, and we're running a lot of analysis behind the scenes to figure out how can we optimize your investment returns by investing you in these different areas. So let's say we decide we do want 10% in international investments. There are thousands and thousands of international investments to be in. So, and do we want to use a mutual fund, which is actively managed? Actively managing, meaning there is a portfolio managing, choosing what stocks to buy and sell. Or do we want to use an ETF, which is an exchange traded fund, which is just a basket of international investments, and no one's really choosing what to put in that basket per se, or no one's doing the research on the companies, right? So that's step 3. And then step 4, we're continually monitoring it, right? We update step 1, the forward-looking market assumptions annually. So that could change the portfolio. Maybe we like international more. Maybe we like international less. And then we're also looking at, has your risk tolerance changed? Has something changed in your financial life? So this is a continual process when it comes to investing. One of the other things too to look at is just being more diversified. So here we have 2 investment strategies. One of them has some access to some different areas in the market, right? The first strategy, both of these investment portfolios has the same amount of equities in it, but the second one is just more diversified. Okay, it has access to more areas. A REIT is some real estate. The EFI is some international exposure. So we're seeing 2 investment strategies with the same volatility would be a way we measure risk. So the higher the volatility, the more risk. So these 2 portfolios really have about the same level of risk, but having it be more diversified is actually leading to a higher rate of return. In this example, we're seeing a 6.6% rate of return versus a 7% rate of return. So This is one of the things going on in the scene that if you're working with an advisor, they should be doing it for you. Or if you're choosing that easy button when it comes to those target date retirement strategies, is happening for you already behind the scenes. And one of the things to think about too is as you go up in the net worth space, meaning if you have more than $1 million of money to invest, it doesn't have to be in these investments, but your investment portfolio has to be $1 million or more. And this is between like what you have saved and your spouse has saved or significant other. In that situation, you have access to what we call some private market strategies. And private market strategies, here we have that level of risk again, volatility on the bottom. We have investment return over here. This is giving us a 5-year time period from 2017 to 2022. And private equity has given close to a 20% rate of return, but it's taken less risk than the US stock market during that time frame. So if you have a net worth above that area, thinking about alternative investments is something you would want to do and talk to your advisor about because you don't typically have access to that inside your employer's retirement plan. Your questions, Kyle? See you coming back on the screen.
Is a question about annuities,
Mm,
how that works, and if those are something that how that factors into this.
yeah. Um, so annuities are a maybe. Sometimes they're great for clients. A lot of annuities I like are almost creating a personal pension for you. So there's a lot of different types of annuities out there. There is a fixed rate annuity. If you have an account at TIAA Traditional or TIAA and you're invested in TIAA Traditional, TIAA Traditional is a fixed rate annuity. Okay, it's giving you like a 3 to 4% interest rate. And then when you retire, you can take the money in that investment. You can annuitize it, meaning let's say I have $100,000 in that investment. I give TIAA my $100,000. And for the rest of my life, they send me a $500 check each month. Okay, that would be like what a fixed rate annuity looks like. There are some variable rate annuities, meaning that's invested in the market. There are indexed annuities. So it depends on what your individual needs are. Some people really do like that fixed rate annuity and creating that like almost a personal pension, right, to help supplement their Social Security. For a lot of people, annuities have higher fees. Okay, there's a higher fee structure in them. In addition, if the advisor isn't working as a fiduciary, like a fee-only fiduciary, they can make a pretty high commission when they're selling you an annuity. And so I would just, I just encourage you to be cautious that if you're going to one of these dinners that some advisors are putting on, and they're really kind of pushing you some annuity products, I would just be cautious about the commissions they're earning on those and is it the right fit for you? A fee-only fiduciary isn't earning on a commission, so they charge a fee for their services versus a normal like maybe advisor who's just selling you an annuity. So annuities can be the right fit for some people. I would say personally, I don't have a lot of clients that use annuities. But we do have that conversation and we review the pros and cons and determine if it's right for them. Make sense? Good question. Keep them coming, please. And so this is just another example about how putting alternative investments in an investment portfolio could potentially increase your returns, lower your level of risk, and provide, our goal, name of the game is to optimize your investment strategy, right? For the level of risk you're comfortable bearing, we want to get you hopefully the best rate of return possible. So this is talking about bucket investing in retirement. So in the accumulation phase, when you're saving for retirement, every time you put some money into your account, it's just properly invested and diversified, right? So much in large companies, large cap stocks, so much in small cap stocks, and it just is nicely invested for you and diversified for you. If you typically keep your money with your employer-sponsored retirement plan, when you ask to take money out, let's say you want them to send you $1,000 each month to your bank account, okay, to help supplement your income in retirement. They, at your employer retirement plan, your Fidelity, your TIAA, your Empower, your Principal, okay, there's a lot of different record keepers out there. They're going to sell out pro rata, meaning if 50% in the market and equities and 50% is in fixed income. Every month, they're going to sell $500 of what's in the stock market, your equities, and $500 of what is in your fixed income, and they're going to send you your check, okay, to your bank account. However, in retirement, a strategy, and this is from Charles Schwab. We have the source down here about it. You can Google this and find it easily. In retirement, I really think it's better to split out the accounts. So we would take your equities, your equity, the 50% you have in equities, okay, and we would put it in your long-term bucket. We put that in its own separate account, an individual retirement account. So there's no taxes or fees or charge when you're moving it over. We put that in its own account. And then we take the conservative money, the 50% that's in like fixed income type investments, we put that into the short-term bucket, okay? And then we link the short-term bucket to your bank account. And as you see here, there's also talk about supplementing your income with an annuity. So your Social Security goes into your bank account, maybe an annuity payment goes into your bank account, and then any money you want to take out of your investment portfolio is also going into your bank account on a monthly basis. But what this allows us to do is be really strategic about when we sell out of the long-term portfolio, right? Think about it. If you hear a rule for investing, a very popular rule for investing, Kyle, what do we want to do when we invest? We want to buy low. Do you know?
Sell high.
Buy low, sell high. You got it. And so what happens in this portfolio, if you leave your money at a record keeper, right? When they're selling out of your equities, it doesn't matter if the stock market's doing good or doing bad. They're going to sell, if your money's invested 50% in the stock market, equities, and 50% in fixed income, they're just going to sell it each month. Okay. It doesn't matter if the market's doing good or bad. The bucket strategy in retirement allows us to be really strategic about when we want to sell out of equities. Because eventually, if you had half of your money in equities, one account, half of your money in fixed income, and in the fixed income, the short-term reserve bucket, that money is going to your bank account. Eventually, this account's going to go down, and hopefully if the market's doing good, this account's going to go up. So at the end of the year, you might be at 60% equities and 50 and 40% fixed income. Well, then we can be strategic and we can refill the short-term bucket, right? We can sell some equities and refill the short-term bucket. But if the market was doing bad, we can wait until it recovers and then refill the short-term bucket. So we get to be more strategic about when we sell out of the market. I think that's really important. This is just talking about, my next 3 slides are going to be talking about staying invested during downturns. Okay, this chart goes through 2025, and each of these red dots shows you the low from the market high to the low that year, right? So many of us remember 2008, 2009 when the market was down 50%, right? It was a bad year. But at one point in time, the market was down 49%. But at the end of the year, it really only ended down 38%. And you see all of these up years here. This is the high to low. So there are years where the market was down, it was down 7%, but it ended up 29% for the year, right? So when we look at this, the average inter-year drop, on average, the market from high to low takes about a 14% drop. And media, the news outlets will be like, the market, it's down 14%. And I'll be like, yeah, that's normal. That's normal. And then it recovers, right? Because out of the last 45 years, the market has had 34 of them have had positive rates of return. So when you see the market going down, I do recommend people take caution, but what the more important thing is that we have you in an investment strategy that you can bear the ebbs and flows of the market, because it's going to go up and down, unfortunately. If I could change that, I would. And then this is just looking at different times where we've seen the market have huge drops, and then how many days did it take for the market to fully recover? So in 1987, we had Black Monday. The market was down 28.5%. It took 398 days for the market to fully recover. Okay. The most severe that we've had in the market's really, history outside of the Great Recession or the Great Depression. We call the financial crisis the Great Recession because the market was down 56% and it took 1,022 days for it to fully recover. But I think the story here is that it did recover, right? And ideally, we don't have to take money out of it when it's down. We can wait for it to recover before we start taking money out. Okay. And then this is just another looking at too, like bad times that we've had in the market, like the Black Monday, the 9/11 attacks, the global financial crisis. And when the market hit its low date, each one of these dates show when it bottomed out, the market bottomed out, what were the investment returns the next 6 months and 12 months? And what's really hard to predict when you're investing is when is it hitting its bottom and when is it going to recover, right? Like we would say, I've had people be like, you know what, Melissa? I just don't want to lose any more money. Get me out of the market. I'll get back in it when I feel better. And by the time they feel better, we've already had the recovery. Does that make sense, Kyle? That happens? Yeah. We've already had that recovery. And so they miss out on the recovery, and so they took their losses and they never got that money back. So this just shows real quick, like what if I had stayed? This is a performance of $10,000 from July 2005 to June 2025. Okay. And if I stayed invested the full time, that money would have grown in the S&P 500. The money would have grown to $66,000, right? But if I missed the top 10 days in the market, we would have only had $29,000, like $30,000. If I missed the best 20 days in the market, so you can see the thing here was like it's just really hard to time the market. We just say, stay invested through the ebbs and flows.
Well, so we had a question about, which I think you've actually maybe addressed about, when do I panic when I get my statement and I see that the market's down, right? And I've lost money out of there. I think you've addressed that a little bit. And then a sort of related question of how does that panic or how does my approach change? That looks very different from somebody who is maybe at retirement or very close to the point of retirement versus somebody who's
Hmm.
25 years from retirement.
Yeah. So it's really about being in the level of risk that's appropriate for you for where you're at. Okay. So like if you are 25 years old, you should probably be typically we would say you should probably be pretty aggressive with your investment strategy if it's money for retirement, right? Because no matter the ebbs and flows of the market, you're going to be that person in that previous screen that we just had who has plenty of time for it to recover, right? And if they get out and they get concerned, um, then they're going to miss out on those best days of the market because usually some of the worst days are usually followed by some of the best days in the market. For my retirees, we go through and we do a financial planning process and we look at, okay, the worst downturn that we've had is 2008, 2009, where the market dropped 56%. It took 5 years for the market to fully recover. We want to make sure we have at least 5 years of money in conservative type investments so that if the market does take a downturn, we have plenty of time for it to recover, hopefully, before we need to dip into it, right? So we have to think about what's your cash flow needs, how much are you going to be withdrawing out of your investment portfolio, how much will we need over the next 5 years, have that in more conservative types investments. And then the rest of it can be in equities. And that's one of the things about that bucket strategy is there's some studies behind it that so psychologically you're more likely to stick with your investment strategy when you can look at the one account and say, oh, that's money I don't need for 5 to 10 years. Even if the market does fall, I have plenty of time for it to come back before I have to touch that account, right? And then the other conservative money, you can say, that's the money I have, it's safer, it's more conservative, and that's the money going into my bank account, and I'll be just fine. But then in financial planning too, with our financial plans that I run for people, um, we're modeling out worst case. We model out a 2008, 2009, and we kind of make sure that your spending is still going to be okay, even in how much you're taking out of your account will still be okay, even if the worst case happens. And if the worst case doesn't happen, you get to spend more money. But, plan for the worst and hope for the best.
Yeah, thank you. Another question that we got was about cryptocurrency.
Mm.
It
Hmm.
says, what percentage of your portfolio would you suggest investing in cryptocurrency now that it is becoming available to trade through brokerages like Fidelity?
Yeah. Well, I work with two custodians. So ClearVista Advisors is an independent advisory firm, and I work with two custodians. I work with Schwab, and I work with for my personal clients, right? That I'm managing their own money. Some have accounts at Schwab, some have accounts at Raymond James. Raymond James's stance is they still won't touch crypto. So just to let you, Raymond James is known to be a more conservative firm. So if I have clients that want some allocation to cryptocurrencies, we have to hold it at Schwab. So just to give you an idea, I do think financial institutions will come around. I do think we're going to see most currencies move to digital over probably my lifetime, definitely my children's lifetime. Good or bad, I'm not here to debate that today. I think it's just, part of our future. But I look at crypto and say, how much risk do you want to take? Because on a risk scale, I think don't quote me on this, it's somewhere between 3 to 5 times riskier than investing in the S&P 500. So we have to think about what's the level of risk you want in your investment portfolio. I will say that's something that I only do for clients that are specifically asking for it. And then we are looking at, a small allocation to that just because it's it's considered to be very, very high risk at this time. So good question though. Another one we have going on right now is gold and silver, just because it's been having amazing returns rate recently, but that's only happening for clients who are specifically asking for it because Raymond James just posted a commentary on gold and silver yesterday saying it's valued very high right now and they wouldn't recommend putting more money into it at this time. So yeah, but good questions. All right, so individual retirement accounts. So that's just one of the reasons why you might want to consider, what we just covered, some of the reasons why you might want to move money working with a financial advisor and moving it to an individual retirement account. When you move the money from your employer-sponsored retirement plan over to an individual retirement account, that's considered to be what's called a qualified transfer. It's like a rollover or an IRA to IRA transfer, and there's no tax penalties for doing it as long as you're like over 59 and a half when you do it. You should be able to move that money over just fine. Okay. Or you're no longer with your employer. Investing bucket strategy, alternative investments. And then, cons of working with an advisor, and we're going to talk about costs here in a second. There's a fee, right? When you hire a financial advisor, nothing's free. So they're getting paid. And I really hope that you're finding out how they're getting paid. Because if they're not charging a fee directly to your account, they're getting commissions or they're getting paid through the investments that you're using. So I think it's very important that you ask, how are you getting paid and how much are you getting paid? So you have an idea of what that looks like. Okay. How much can I withdraw? Right? Okay, so I saved up $500,000 for retirement. I saved up $1 million for retirement. There's a typical rule out there that says the 4% rule, which means you can take out 4% a year of the account and not hopefully run out of the money. But we're going to talk about that a little bit more here and why that sometimes doesn't work. We're talking about sequence of return. We're talking about how our spending patterns change in retirement. So,
Melissa, your slides are not up.
oh no, thank you. All right, hopefully it's better now. So 4% rule here. So here's just an example of a $1 million portfolio. In this portfolio, 40% is in equities and 60% is in fixed income for this person. So it's on a little bit more of the conservative side of investing. And you look at the different distribution rates of, if I just take 4% out each year, how many years will my portfolio last me? Right? And if you do 4% every single year, there's a pretty good chance that it's going to last you for about 30 years in retirement. Okay. If you take out 5% of the portfolio a year, we're somewhere between 20 and 25 years. And if we're taking out 6% of the portfolio a year, odds are maybe less than 20 years that the money is gonna last you. So something to take into account here. But I would say, what are the odds that every single year in retirement, my spending is the same, right? Typically, and I hope this is my next slide. Yes. Typically, we have an active phase of retirement. When we first retire, it's very likely that for the first half of your retirement, you're in the go-go phase. You're doing more things, right? I've had clients who travel more. I've had clients who rent a condo down in Florida for a month each winter. I've had clients that have bought an RV and are traveling the country. I have clients that like to do a lot of international travel. I have clients that are just really active with their grandkids and are spending more money on their grandkids, right? Things are not getting cheaper these days. As I have a 15 and 13-year-old at home, I know that for sure. And then once we're in retirement a little bit, 10, 15, 20 years in retirement, we kind of go into the slow go phase, right? We're not chasing after the grandkids as much. We're not traveling as much. And we see spending kind of drops. And then towards the end, it's questionable, But we're talking about, what's the cost of like healthcare and long-term care. So we see typically in retirement, higher spending, lower spending, higher spending towards the end because of healthcare cost. So that 4% rule doesn't really work when our spending is so variable, right? Maybe I want to spend more at retirement, but I'm not going to spend as much at the end. Another thing we have to take account for, and this is all going to come together here in a second, but another thing we have to take account for is the fact that unfortunately in retirement, we don't get the same rate of return every single year, right? So this shows, we're modeling out three different return patterns. One is a good start, meaning I'm getting really good investment returns at the beginning of retirement, and then at the end of retirement or at the end of the situation over this time period, I'm not getting as good of returns. The other one's just showing a steady 5%. And the other one is showing bad start, meaning when I first, at the beginning of this time frame, I'm not getting very good investment returns, but at the end, I am getting good investment returns. All three of these scenarios, when you average out the returns, they equal 5%. It's just a matter of like, did I get the good investment returns at the beginning or did I get the good investment returns at the end? So for someone who put in over the last 30 years ago, put in $100,000 and invested it, it doesn't really matter as long as they were invested that whole time and they just kept it, left it, and forgot it. It doesn't really matter. They would have ended with the same value at the end. Okay. But during the savings time period, this one's showing someone who's saving $10,000 a year, right? Every single year. But sometimes it does matter. The ending account balance does matter if you had a great start of your returns and towards the end of that 30-year time period, you had bad returns versus if you had a bad start, but then great returns at the end. So bad start and great returns at the end, if you've been saving $10,000 a year, well, towards the end there, you have really good investment returns. And that's when your investment portfolio is going to be worth more, right? Because you've been saving all these years. And so that's the ideal situation, right? Versus just the steady Eddie 5% rate of return every year. But in retirement, this is modeling out the 4% withdrawal rule. 4%, and we're adjusting the withdrawal by 2%. Like, so let's say on $1 million portfolio, you're taking out $40,000 a year, and we're giving that a 2% inflationary increase each year. Okay. So this is the retirement phase. This is the decumulation phase down here. And sure, if you could get that steady Eddie 5% rate of return, and you were taking money out, you'd be just fine. Your money would last you over retirement with that 4% rule. If you had a great start to retirement where you're getting great investment returns at the beginning of your retirement, but then you got bad investment returns towards the end of retirement, you're fine too in this situation. What hurts people the most is when they have, these are the people that during 2008, 2009, the financial crisis, who said, I can't retire anymore. They saw their portfolio have really bad returns at the beginning and of retirement, and now we're taking money out of that investment strategy, right? And not as much as there to recover. And then they were seeing their money potentially run out after about 25, 24, 25 years. So that's where planning for retirement, it's not static. And that's another reason why I'd say work with a financial advisor, work with a financial planner, hopefully a financial advisor that is doing financial planning or has someone on their team that's doing it, because we're modeling this all out every time, we meet with a client to say, okay, where are we at? What are the market returns? Do we need to adjust your spending? Or when you call your advisor up and you're like, hey, I was thinking about buying a car. I'd like to just pay cash. Can I do that? Versus, and take the money out of my retirement portfolio versus getting a loan. And your advisor is going to be like, yeah, or instead of buying that, $50,000 vehicle, we should really be looking at a $35,000 vehicle right now because of where your portfolio is at. I will say, thankfully, I've only had a few clients over the years where I've had to say we need to scale back some of your spending habits or some of your financial goals. Most of the time, we're able to say, yeah, go ahead, pay for that car with cash. It's fine. But at least our goal is to make sure you don't run out of money, right? That's the name of the game. Got questions?
A question about taxes and minimizing tax risk.
Ooh, yeah, taxes are good. Um, so I think taxes are really important. Um, So one of the things we're going to talk about at the end of this presentation is Roth conversions. And if you have money in Roth and how to navigate that. One of the things that we're going to talk about next month is about how Social Security isn't taxed as much, right? So only 85% of your Social Security income is taxable income, meaning that if you get $1,000 a month from Social Security, the IRS only looks at 850 of it as taxable income, right? So if we can get more money from Social Security, maybe because you delayed to take it, we can reduce taxes. But what happens in retirement, especially if you're working with your employer retirement plan, or you're working with an IRA, each month that we're sending money to your bank account, you can put withholding on file. So a lot of my clients are in the 12% tax bracket in retirement. And so every time we're sending them their $1,000, we're also withholding what we need to from their account to cover the 12% in federal taxes. And then if they have state income tax too, Michigan just changed theirs. I don't think they're taxing distributions from IRAs anymore or from your retirement accounts, which is great. I think that phased out this year. So we don't have to withhold state withholding in the state of Michigan. Florida doesn't have any state income taxes, so we don't have to withhold there. But we'll look at what state you're in, and we'll just go ahead and like send those payments out for you. And then at the end of the year, you get a document called a 1099-R, and it shows how much you took out of your retirement account and how much has already been withheld for taxes. But yeah, ideally, if you have like a big year that you need to take big withdrawals and you have some money in a Roth, either in your employer's Roth or retirement plan or in a Roth IRA, we might consider taking some money out of your Roth IRA that year so that we're not moving you up into a higher income tax bracket, because that next jump from 12 is 22, which is a crazy jump, 12% to 22%. So obviously if we, can not have you, or if I know a client has a big withdrawal coming up next year, we can talk about, okay, should we take a little bit more money out this year so that we can keep you in a lower tax bracket? So it is, tax planning in retirement is kind of strategic to make sure we can try to pay as little as, I think we already pay enough money in taxes. So as much as we can save, the better. Good question. More questions? All right. Yeah, so when we're thinking about how much you're going to withdraw, we want to identify your financial goals, right? How many years do you want to travel? How much do you want to spend on travel? How much do you need to live off of in retirement for your basic needs, gas, groceries, property taxes, electric bills, utilities? How much do you want to, do you have any large home improvements coming up? We budget for those because one thing that if you want to live in place in your house, roof, air conditioning, furnace, replace every, 20, 30 years probably. Vehicles every 5 to 10. So we want to budget for those things and put those into your plan. And then we look at the resources you have to fund those goals: Social Security, pension income, annuity income, your investment savings, your retirement accounts. And then we talk about how much risk you want to take in your investment portfolio so we can kind of estimate, hopefully, a investment return in your portfolio, as well as the amount of volatility we might see in your portfolio based on the level of risk you're taking, your investment portfolio. And then we show you results. So this is where you're like, am I on track? Melissa, can I live off of $5,000 a month and spend $10,000 a year on travel? Can I replace a vehicle, a $30,000 vehicle every 10 years? Can I leave some inheritance to my kids? Can I pay for long-term care at the end of my life? We'd put all that in here, and then we would get a success measure and be like, yeah, you're on track. In fact, you can spend more. Or, oh, can that $5,000 be $4,500 a month? Or, you know what? You'd be on track if you just work 2 more years. Is it worth you to work 2 more years in order to be on track? So that's kind of what it looks like, the financial planning process, which really goes into how much can I withdraw, right? And the success measures. All right. Last but not least is the other tips and tricks. So hopefully you're still with me. I'm not going to spend too much time on asset location, but I want to mention it to you because if your advisor's not doing it, they should be. Then we're going to talk about required minimum distributions as well as qualified charitable distributions. And then we're going to talk about Roth conversions. And last but not least, I'm going to talk about the things you should be looking for in working with an advisor and the typical fees they charge, just so you know. So when we think about investing, there are certain accounts that we should hold certain investments in for tax efficiencies. So this goes into the tax efficiency play as well. Roth IRAs, for example. So here you have a taxable account. A taxable account is going to be like, Melissa, this isn't a retirement account. This is just money. I opened up an account at Charles Schwab. I started putting a couple $100s in it a month and I invest it. And when I sell those investments, I have to pay capital gains taxes. And when I sell those, or every year I get a 1099 showing my dividends and my interest, and I have to pay taxes on those as I go. So that would be a taxable investment account. Okay. It's a non-retirement investment account. A tax deferred account would be like the money that you put into your employer plan on a pre-tax basis. It's your non-Roth money. So the money your employer put into your retirement account, maybe the money you put in on a pre-tax basis. If you never chose to put money into your retirement account as a Roth contribution, meaning an after-tax contribution, then that's tax deferred. That's just typical money. Tax deferred money would roll into an individual retirement account, right? Your pre-tax money. Tax exempt money would be like your Roth money, meaning when I put money into my retirement account, I already paid taxes on it. It's after tax money that went in there. It's tax exempt money. And so now that Roth money is growing tax free. And when I take the money out, I don't have to pay taxes on it because I already prepaid my taxes. That's Roth money. And you can have both in your employer's plan. You can have pre-tax, tax deferred money, and you can have Roth money, tax exempt money, and both of those can be in your employer retirement account. And if you decide to use IRAs, your tax deferred money, your pre-tax money would go into an IRA, and your tax exempt money would go into a Roth IRA. Okay, that's how that works. And because Roth IRAs are growing tax-free for you, right? I already prepaid my taxes. I want that account to grow as long as possible, tax-free as possible. And I usually want to have my most aggressive investments in there. We have a question, Kyle?
We do. Do you have a recommended contribution rate? I've heard anywhere between 15 and 20%, and even in some
Mm.
cases 25%, which can feel a little out of reach depending on life circumstances. And then is that contribution rate pre-tax or post, based on your pre-tax or post-tax income?
Oh, such good questions. Okay, so at the end of the day, I'm going to say I will do a financial consult with anyone, complimentary. And sometimes we're a good fit to work together, and sometimes we're not. And I'm going to tell you like your next best steps then, where you should go or what you should be doing. So feel free to reach out because this is very specific to your situation, right? How much should I save? Well, how much do you want to spend in retirement, right? Like typically, if you start saving in your early 20s, between what you're contributing and what your employer is contributing, you can save about 10% of your compensation. And you're typically going to be okay. Anywhere between 10 and 15% between what you're putting in and your employer's matching. So if I'm putting in 5% and my employer is matching 2%, I'm at a 7% contribution rate. Okay. But we really want that to be somewhere, if you start saving in your early to mid 20s, we really want that to be somewhere between 10 and 15%. The later you start saving, if you don't start saving till your mid 30s, fast forward 10 years, yeah, sometimes we're up at a 20-25% savings rate, right? Or or you just say, you know what, I'm not going to need as much when I retire as the average person, and so I'll still be okay. But there's a little bit of math and calculations to go into that, and these are very just like typical rule of thumb. If you're a high income earner, you're not going to get as much money from Social Security because your Social Security payment maxes out at a certain point. And so you might have to save even more if you're a high income earner than someone who's not a high income earner. So it's very specific. And we can just run some quick calculations to kind of figure out what's right for you. Roth, I love, love, love Roth contributions. And in fact, it's going to be at some point in time that you're going to be able to elect to have your employer contributions, your employer matching contributions, or what they contribute to your retirement plan. You're going to be able to elect to have that go into what I call the Roth bucket too, right? Um, I personally feel that the only people that shouldn't be saving in Roth are my really, really high income people who are going to be like, we're talking doctors, attorneys, lawyers who are like, in the 32-35% tax brackets. There is some calculators out there I can provide that will show you, should I save in Roth or should I not save in Roth? But I really, really like the benefit of having that money grow tax-free for you. But we can run a calculator, we can look at your financial situation, and we can determine, does a Roth make the most sense for your situation? So, yep. Okay, so back to asset location. This is just talking about your advisor should be looking at, I want to have, if you're having actively managed stock portfolio, you might think about doing that in the Roth because that is growing for you tax free. So different types of investments are better situated in certain portfolios, right? So municipal securities, exchange traded funds would be the best. Exchange traded funds are known to be more tax efficient, would be good in taxable portfolios versus like a high turnover, meaning you're buying and selling a lot of stocks or mutual funds for equities for the stock market would probably be better off in like your Roth account. So, all right, for those who are retiring, eventually, if you have money, another advantage to Roth IRAs is that you don't have to take a required minimum distribution. Okay, your Roth money doesn't have this required minimum distribution. But any money in your employer plan that's pre-tax or any money that's in your IRA, right, a pre-tax account, you've never paid taxes on that money. It's tax deferred. It's growing in there, and eventually when you take the money out, you're going to have to pay taxes on it. Uncle Sam says there's a certain age at which where they're going to require you to start taking some money out of your IRA, your individual retirement account, and pay taxes on it. I will say that for most of my clients, what they're taking out on a monthly basis to help supplement the income they need in retirement is usually more than enough to meet the required minimum distribution. However, I do have some clients that between what they're getting from Social Security, they've both worked. Maybe they're getting $4,000 or $5,000 a month from Social Security. And they're like, well, we don't really need that money. We just want to keep it growing. We want it to go towards inheritance. We want, whatever it is. Well, for those clients, they do have to start taking out a required minimum distribution, take the money out that's required, pay their taxes on it, and then they can either choose to spend that money or they could choose to move it to a taxable investment account and keep the money invested. The government just wants you to start paying money. Okay. So I don't make the rules. So here are the different years when you're born as to when you would have to start taking a required minimum distribution. However, one of the things I do like is talking about qualified charitable distributions. Do you have an IRA? Yes. Are you above age 70 and a half? Is when you can start doing qualified charitable distributions. But we'll talk about it for today's purpose. We'll talk about it with regards to your RMD, your required minimum distribution. So, do I have to take a required minimum distribution? Yes. Do I have give to charities? Yes. Okay. Well, a qualified charitable distribution allows you to take that money from your IRA, take a distribution. The check has to be made payable directly to the charity that you give to. Any 501c3 qualifies. So usually most churches would qualify if you tithe. Otherwise, other charities. Grand Valley would qualify if you give to Grand Valley. Okay. So that money comes out of your IRA. The check is made payable directly to the charity. The check can get mailed to you or it can get mailed directly to the charity. And then that will count towards your required minimum distribution. Okay. And the money that comes out and goes to the charity is not taxed. So it's a way for you to give to the charities and not have it be taxed. If I give money that's in my checking account at the bank to the charity, I can sometimes take the tax deduction on it potentially. But if you're giving over $1,000 or $2,000 and you're using standardized deductions, you usually can't get a tax benefit for it right now. So this is a way of saying, yeah, I do like to give $10,000 a year to charities. Right now with current rules, if you're married, you can only take 2,000 that as a deduction if you're doing standardized deductions. So this is a way for us to give to charities. It reduces your required minimum distribution and you don't have to pay taxes on the money that you gave to charities. Okay. So in this situation, Phil has a $15,000 required minimum distribution. He gives $10,000 of it to charities. His remaining required minimum distribution is only $5,000. He has to take that $5,000 on, pay taxes on it, and then he can do with it whatever he wants. Questions?
Do you typically aim to withdraw from tax deferred accounts before a Roth account?
Mm,
And how does Social Security play a role in withdrawal strategy?
yep. So Social Security, I'm going to encourage you to attend the February one because we're going to talk a little bit about that. Because just because you can claim Social Security doesn't mean you should claim Social Security. For every year you wait from age 62 to age 67, you get about a 6% increase every year. For every year you wait from 67 to 70, your Social Security payment increases by 8% a year. There's strategies behind when you should claim Social Security. Social Security isn't taxed as much as the distributions from your IRA. So I'm going to encourage you to attend the webinar that we have in February. It's also going to be recorded. Um, and then when you should claim Social Security also really depends on how much you have saved. Just because your neighbor claimed at 62 because they didn't have any retirement savings doesn't mean you should claim at 62, right? So like it's very personal to your financial plan as to what is right for you. If you're married, that will impact it. If you've been widowed, that can impact it because you'll be having a survivor benefit. If you were married for 10 years and you got divorced and haven't remarried, that can impact it. There's choosing Social Security and how this comes into your cash flow plan, it just depends on your situation a lot. What was the second question?
Do you typically aim to withdraw from tax deferred accounts before a Roth account?
Yeah. So on this next screen here, we're talking Roth conversions. So my financial planning system also has a tool in here called our tax optimizer. And advisors are not tax advisors. We cannot give tax advice. You have to go to a CPA or a tax attorney for that. However, we can provide information and education. And then we will tell you to go talk to your CPA about it. Okay. But in here, there's a tool in here that talks about the withdrawal sequence. And typically, for most people, it can make sense to, if you have taxable investment money, that's the least tax efficient. So usually we would spend down that account first. And then we would start spending down your pre-tax money, your tax deferred, your IRA money. And then last, we would typically want to take out of your Roth IRA or your Roth money. The reason for that is we want the Roth money to grow tax-free as much as possible. Your Roth money doesn't have an RMD required on it. In addition, your children will inherit the Roth money and they don't have to pay taxes on it. So if you're in a 12% tax bracket, but your children are doing really, really well and they're in a 32% tax bracket, you're leaving more to them tax-free by allowing them to inherit that. Because if they inherit your IRA money, they're going to have to take money out and pay taxes on it at their tax rate. If they inherit Roth money, they get that money tax-free. So another reason why we like it. But this tax analyzer will take a look at it and provide recommendations about how much should we take out pre-tax and how much should we take out Roth, because sometimes situations do vary and it can save money to sometimes it's strategic to take a bit out of your Roth each year. Okay. Another thing too is talking about Roth conversions. I think a lot of people don't think about this in retirement. So Roth conversion is where I have money in my IRA. And sometimes I have people who retire, and at the beginning of retirement, they are in a they're in like a 10% tax bracket or 12% tax bracket. And we will strategically start converting some money each year from their IRA to their Roth IRA. They say, we run the analysis and it says, yep, this year you should convert $10,000 and you'll still stay in the 12% tax bracket. And so they'll convert $10,000 and move it to their Roth IRA. And we might do that each year. And in this just strategy that I ran for a client, by doing so, looking at how we were going to convert things on a tax adjusted basis, their ending assets, meaning like what do they have left for like inheritance or at the end of their lives. In this situation, it gave them $238,000 more on an after-tax basis by completing these strategies over their lifetime. So it's specific to your financial plan. It's specific to like what's your tax bracket versus like your children's tax bracket, right? When they inherit the money. But it can make sense. So yeah, that was withdrawal order you were talking about there, the withdrawal sequence, but also Roth conversions can make sense too. So more questions, Kyle?
Another question, and maybe you'll be getting to this. I think you are because you mentioned it, is how much should I be paying a financial advisor?
Yeah, that's going to be the next slide. So great question. So 3 E's, look for an advisor. What is their experience? We want to see advisors who have been in the industry for a while. If they're a new advisor and they are partnering with an advisor that has tenure, I think that's good too, right? I remember those early days where it was like, oh, I didn't have 5 years experience yet. I didn't have 10 years experience yet. I did have a partner at the time. So you're kind of leveraging their experience and expertise too at the same time. So if it's a new advisor and they don't have a ton of experience, I would say hopefully they're on a team with advisors that do have experience. Have they been through downturns? What is their expertise? So for me specifically, I do retirement plan consulting, and 90% of my clients are retirees. That's really my area of focus. Some advisors just work with doctors. Some advisors just work with dentists. Some advisors work just with executives. My kind of area of focus is really working with a lot of retirees. I do have some executives I work with. I do have some other people I work with, but just kind of that's my area of focus. Are they a fiduciary? A fiduciary, I call it the F word in this industry, the fiduciary. Fiduciary means that when they make a recommendation to you, they are legally bound to make sure it's in your best interest. And as long as they're your advisor, your fiduciary advisor, they have an ongoing um, commitment to making sure that recommendation stays in your best interest. Okay. An advisor that's working, a fiduciary is going to charge a fee for their services. Okay. An advisor who's not a fiduciary is going to be charging a commission. Either they're getting paid a commission trail from the mutual funds they're using, they're getting paid a commission when they're doing the stock trades in your account, they're getting paid a commission when they are selling you an annuity. Okay. That would be like the opposite. We call that the suitability standard versus the fiduciary standard of care. And they're different legal requirements. So you really want to find an advisor, in my opinion, that's a fiduciary. And then understanding their fees. Hopefully a good advisor is coordinating things to kind of are you be your own personal CFO. They're coordinating things for your CPA. If you have an estate planning attorney, they'll coordinate that. And then they have a whole team of depth underneath them to leverage. What do fees look like? Here's the average in the industry for a study. It's hard to find studies out there. This one was 2004, but I do trust this resource, the Kitces report. And he surveyed a bunch of advisors and said, what are you charging? So assets under management mean what is the money that advisor is managing for you? So if the advisor, you kind of see the line here, that's the median fee. And then the range is kind of like the common fees. And then outside that range would be uncommon fees. So you're kind of seeing the 1% range be the standard for less than $1 million. I have a little bit different fee structure, but at $1 million, it is 1%. And then over that, as you start going up the net worth space, you should see your advisor's fees be a little bit less. So I only have a problem with a fee if I'm not getting value. There's a reason for the smartphone of mine that I pay so much money for it, right? It's a computer, it's a calendar, it's my phone, it's a camera, right? I pay a lot of money for the smartphone because I get a lot of value out of it, right? So what's the value an advisor bringing? And that's where Vanguard did a study. You can source these studies. Morningstar also did a study. Vanguard study, I like this study better, came up with the average value an advisor is bringing about 3%. However, you're going to notice 1.5% of the advisor's value comes from this thing called behavioral coaching, meaning when you call your advisor up and say, the market's down 15%, what should I do? And they say, remember the financial plan we walked through? Remember how you're going to be just fine? Remember how we planned for this? And you stay the investment course, you stay the course. That's behavioral coaching. Okay, so some people are better at that than others. Staying the course. So that's the 3%. Morningstar did a similar study. They didn't include behavioral coaching in there, and they came up with the 1.59. So both studies really kind of came pretty even for the value of an advisor. I will say what's not in here is things like financial planning things, right? The tax efficiencies, optimizing your Social Security, Roth conversions, doing the qualified charitable distribution strategies. So this is really just when it comes to managing your investment portfolio. It doesn't have to do with all the other advice your advisor might be giving you. So just kind of keep that in mind. I think the value is actually greater. So, but that's kind of like what the industry averages. So that's my entire spiel. I only went 1 minute over. And like I said, if you're interested, you're free to shoot us an email. Here's my website. Here's my email. Give us a call. Give me a call. You're welcome. Like I said, I do those complimentary sessions with people all the time. I just ask you, fill out a questionnaire. We kind of go through a preliminary financial plan, see where you're sitting, and then I provide you what your next best steps are. But otherwise, I just hope you are working with a great advisor who can help you along your journey.
Thank
So,
you so much, Melissa. We appreciate you taking the time to share all your expertise with us and answer all these great questions. And thank you to everyone who joined us today. Keep an eye out for some follow-up emails with additional information from Melissa and the recording from this webinar. And I also dropped the link in the chat for some of our future upcoming webinars on retirement with Melissa, including the Social Security one that she mentioned.
great. Thank you so much, Kyle. Thank you for coming today.